Happy Friday and welcome to another morning live with Real Estate Mindset, where we get to grow and become empowered together. So if you wanted to learn about real estate and kind of what's going on in the economy, you guys came to the exact right place. And don't worry, everything will be chapters. So if you don't want to watch this whole thing, that's perfectly fine. Now I'm going to start this live a little bit differently today, and we're going to study just a few terminology on what's going on in the economy. The reason I want to do that is I see some people, not all people, but some people are being out-talked by these smooth talking salesmen and saleswomen. So I want to give you guys a little bit more ammo, and I want to kind of just have a refresher on some of these terms. And I think you guys are going to find it very, very valuable. So again, really happy you guys are here. Very excited. Happy Friday. Just wanted to say good morning real quick to Eddie, to Luke, obviously my boy Trey. Trey, I love you, brother. I am proud of you. This man is using the beef jerky method to increase his credit score. Super proud of you, Trey. Super proud of you, brother. Good morning to Mostly as well. There's my man, Raymond. Raymond, I'm super proud of you as well, man. Don't forget, we love you, brother. Always remember that. We are blessed. Okay, thank you for the reminder. I am Winnie the Pooh. Really appreciate you. Everyone, appreciate everyone. Neil. Mike, the good news is we're going to learn. Isn't learning good news? Isn't being empowered good news, or is that bad news? I don't know. I think it's good news. I think so. You guys let me know. But good morning to everyone. Really appreciate you. There's my buddy Dean as well. All right. There's my man. There's Steve. Oh, there's all you guys. Night Cree as well. There's Cindy. Oh my gosh, I'm going to get stuck here. Oh, I love you guys so much. Anyways, okay. So we're going to get started right now on the terminology. I'm going to throw up a quick timestamp. And for you guys that may already know these things, this will be very, very fast, but this is very, very important because we hear this terminology everywhere. And where I want to start, again, this will be quick. I want to start with the differences between real and nominal. Okay, I know the solar flares, Johnny. There's some solar flares. Okay, big shout out to Johnny. I know there's some solar flares. It freaks me out. All right, I'm not even going to cover it because I'm too afraid to cover it, just like immigration. Now, the differences, guys, pay attention. The differences between real versus nominal. And I'm going to read this. I'm just going to read this. And I'll share my opinions if there is any. But for nominal, okay, nominal is the current value without taking inflation or other market factors into account. So nominal is basically is what it is. So when you hear nominal, it's the actual price, no adjustments. Now, when we look at real value, okay, and the reason this is so important is there's a lot of realtors and investors that are now pushing people to purchase real estate because they're saying, hey, there's been a decline in prices, real prices. And again, I just want you to know the difference. So the real value, also known as the relative price, is the value after it has been adjusted for inflation. So the real value takes the prices and other market items into account. So again, it's inflation. So real is adjusted for inflation. Understand that. So nominal is what it is, right? It's the price, but real is the adjustment for all of the inflation. So that's really good. Now, here's another thing. I really want you guys to understand this. This may be one of the most important things to understand, okay, of what's going on in our economy right now. Now, I want to explain the differences between Keynesian economics versus Austrian economics, okay? And I'm going to do this very quickly, and I'm going to highlight the biggest differences. You guys need to understand this, okay? I'm an Austrian, right? Austrian economics, but what's happening right now, more of a socialist thing, Keynesian, okay? So Keynesian bad, Austrian good. Now let's read this. Keynesian and Austrian economics have vastly different takes on a wide range of economic topics. However, their key, okay, their key disagreement boils down to one main idea: government economic intervention. So that is the main differences. One hand, Keynesian economics, they want the government to be involved. Okay. The other hand, Austrian economics, they don't want any government involvement at all. Now let's keep reading this. The central idea behind Keynesian economics is that government has the power. Again, the government has the power to stabilize the economy through strategic intervention. And part of strategic doesn't include greed, corruption, fraud, okay, and being irresponsible with fiscal spending. It says strategic intervention, okay? What's been going on has not been strategic. They've just been throwing money at things, helicopter money, okay? Just throwing money everywhere. Anyways, this stands in opposition to Austrian economics, a theory that states that government should have zero involvement in economic process, such as trying to stabilize market prices. Now, I'm going to read 3 bullet points and we'll be done with this. Okay, so bullet point number 1, Austrian economics believe free markets are efficient and self-regulatory. Keynesian economists believe free markets are inherently insufficient and volatile. Okay, bullet point number 2. Know the difference, guys. Austrian economics believes government intervention in free markets makes negative business cycles more severe. So again, Austrians think any government involvement, again, is going to devalue money and make the problem even worse. Wow. Keynesian economics believes government can implement policies to stabilize the economy and mitigate recessions. But again, we have the Greek corruption and fraud, so I don't know if that works. Now, bullet point number 3, okay? Very important you guys understand this. Austrian economics believe companies, again, Austrian economic theology believes companies should be allowed to fail during economic downturns to eliminate the least effective businesses. That sounds like a win-win to me. It sounds like it helps consumers. This process also helps allocate more resources to the most efficient existing businesses, as well as the creation of new businesses. However, many Keynesian economists would argue government investment could help keep major insolvent companies afloat and avoid job losses during recession. Okay, so tell me which one you guys think is best. Do you think it's a Keynesian? Do you think it's Austrian? Personally, I think Austrian theology of economics is vital. The boom bust is healthy. When we go into recession, it's healthy. It's a reset. The Keynesian way is like, let's just keep propping it up. Let's keep propping it up. But let's go on to the next thing, guys. Now I want you guys, again, just some of you may already know this. Okay, but what's the difference between monetary policy, the Federal Reserve, and what's the difference between fiscal policy, Congress? Okay, so monetary policy, like how money is saved, what we could do with money. Fiscal policy is like taxation and spending. And I'll add spending like absolute lunatics. Okay, but anyways, let me read this for you guys again. I want everyone on the same page. Monetary policy refers to the action of central banks to achieve macroeconomic policy objectives such as blah, 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 who cares, stability, interest rates. Okay, fiscal policy. So again, monetary policy like Federal Reserve, policy on banks, things like that. Fiscal policy refers to tax and spending of the federal government. So fiscal is spending, right? They're spending. Fiscal policy decisions are determined by the Congress and the administration. The Fed plays, quote unquote, no role in determining fiscal policy. Now, as far as monetary policy, here's what I'm watching, okay? I think, again, I think 2025 is going to be a compoundingly bad year because we have a lot of things that are, that are coming into effect. I'm so sorry, guys. Let me drink some tea real quick. Sorry. Let me slow my roll a little bit. I get excited. So here's a piece of monetary policy that has been basically in the works for a long time that I believe is going to cause additional credit restrictions in 2025, in addition to additional bank failures for other reasons. But remember, you guys, big monetary policy enacting June 2025. Now, it's called, just in case you guys forgot, Basel III. Okay, Basel III Endgame. So Basel III Endgame is similarly titled to a spy thriller sequel, as opposed to the last stage of U.S. regulators' implementation of reforms meant to ensure the stability of the banking system. Okay, this has been a long time coming, by the way. But instead of that being implemented, banks are continuing to just take our money and spend it like lunatics. However, the banking industry has depicted the reforms, which largely call for the country's largest banks to put aside more capital in reserve to weather financial storms, as a threat to American economy. So they're saying the fact that they have to keep more of our money in the bank is a threat to the economy. And they're only saying, I think, something like 20%. That's my money. So again, I don't want to put my money, or at least all my money, in the banks. They're taking our money and they're getting even richer, and prices are inflaming even more because of the banks. Our own money is working against us. In a lobbying blitz, Basel III supporters have called unprecedented. The banking lobby has amused an army of lobbyists in Washington, D.C., and poured millions into a media campaign to denounce the proposed regulation. They do not want that to happen because this right here, Okay, you see where it says endgame? That Basel III endgame is going to put businesses, banking businesses, out on the street, especially regional banks that don't have the liquidity. I don't think asking for 20% is a lot of liquidity. Now, let me show you guys what the fiscal policies have been doing. Okay, look at this. Because of all of the fiscal policies, all the Inflation Reduction Act, oh my God, you guys, it's all fiscal right now. I mean, everything that's going on in the US right now is all fiscal. It's all freaking spending. You guys, they have so much money still. I'll show you here in a minute. They still have so much money to spend. It's outrageous. And the reason I say it's outrageous is they've already juiced the assets. The assets are oversaturated. Houses oversaturated. They cannot put money into anywhere else in the economy. And so where are they putting it? Where are they putting the money that's locked up? Again, assets are squeezed. I don't care what anyone says. From any historical data point and standpoint, assets, especially houses, are over squeezed. You can't buy any. I mean, there's nowhere. You guys understand what I'm saying? So where are they putting the money? Where are they putting it? You guys, they got so much money still. They're giving it away to immigrants. And I'm not taking a side on immigration. I'm just saying the data is there now to where, I mean, it's undisputable. Immigration right now, whether illegal or not, or whether documented or not, is having a stagflation effect on our economy because they're giving some of the immigration free money as soon as they come into the border. And so if I'm an immigrant and coming here illegal, I'm just going on a merry-go-round. I'm getting my $5,000 check. I'm going back into my country and I'm coming back into the US. I'm getting another $5,000 check and I'm just going to milk the US. If I'm an immigrant, you guys, that's how much money they have. They have so much money that they cannot spend. They're literally giving it away. And it's wrecking us because it's our money. We're the taxpayer, technically. But anyways, that's what our fiscal policy is doing. Look at the deficit. 1 trillion. America forgot what $1 billion is. Think about it, you guys. Like, no one even talks about it. Oh, 72 billion. Who cares? How many trillion? I mean, when did trillion start becoming a household name? I mean, seriously, this is insane, you guys. Anyways, now what I want to do, I'm going to go to the next part of the video where I want to show you guys like what happens during recession. Okay, so again, I want to show you guys what happens during recession. All right, a lot of people forget. A lot of people, oh, Travis, you're wrong. Unemployment's too low. But I'm always like, you guys, the recession hasn't started. Like all of the effects that the technical, okay, I'm just saying the technical, if we look at the deficit, we've already been in, a depression. But the technical recession hasn't started yet. And people are like, Travis, you're wrong, you're wrong, you're wrong. But a lot of what I've been saying follows the recession. Let me show you guys what happens. Now, let's start with unemployment. So remember, you guys, prior to the GFC, prior to the great financial crisis, unemployment was in the 4s, okay, mid to high 4%. You see that? So similar to what it is now, we're at 3.9 right now. Employment, okay, was at 4.7% before the GFC. It took the recession to get us up to 10% unemployment. You guys, once the recession starts, that's when the real bad stuff generally starts to happen. So it makes sense that if we're not in recession, that we don't have an unemployment rate skyrocketing. So again, the unemployment rate did not start skyrocketing until the recession started. And that's not all. Interest rates. Okay, look at 30-year fixed rate mortgages right before the GFC. Look at what rates were. High 6%, mid to high 6%. You see this? So the rates were in the 6%, high 6% going down to the low 6%. And then when we hit recession, rates dropped all the way down into the 4%, to the high 4%. So they go from mid 6s to high 4s. So odds are during the recession, you guys, that they're going to cut interest rates, and they generally, not residential mortgage rates. Remember, it's an overnight rate, it's a federal funds rate. But more than likely, if we go into recession, they will need to stimulate the economy. They will stimulate the economy, and thus they'll drop interest rates. But again, what I'm trying to point out is generally those big rate drops don't happen until we're already in recession. So don't put the cart before the horse. America continues to put the cart before the horse. Let's keep going, guys. Take a look at this. This is the personal savings rate. Again, prior to the GFC, we were sitting at low 2s. That's pretty crazy. High to low 2s. That's insane. Getting up to about 3%. Right now, I think we're at 3.2. So why is the savings rate so low right there? Because everyone's still spending. Look at this. Everyone's still spending like lunatics, kind of similar to what's going on now. But when the recession starts, people start becoming aware. They stop spending. And you guess what, guys? We're in an economy that is dependent heavily on consumer spending. Up to about 78% of our GDP is from consumer spending. So as consumers, we have the power We have the power, but we don't have the unity. If we had the unity, we would be unstoppable, but we don't have the unity. So savings, when we go into recession, explodes. I want you guys to know that because people are freaked out. They're trying to save money and trying to survive, and they stop buying, 30 subscriptions. You guys, the savings rate went from 1.9 all the way to 7.8. Recessions compound the problems that are already happening. Do y'all see that? So understand that's how that works. People stop spending, they start saving. You guys get it? Let's keep going. Credit tightening. So I'm trying to explain to you guys, we got to prepare right now. If we wait, keep our heads in the sand, try to prepare during a recession, we may not be able to. But right now we can. That's my point. An event's going to happen. I don't know when. It doesn't matter when. We already, in my opinion, from all this data, historical precedent, some event is going to happen. It's right around the corner. Look at this. Credit tightening. Credit tightening did not start until we were in recession during the GFC, and they strangled credit tightening. They made it to where it was so hard to get a loan. You guys remember the Dodd-Frank Wall Street Reform and Consumer Protection Act, making qualified mortgages? That rocked the industry. Credit tightening generally doesn't start until we're in recession because the banks are like, hold up, we don't want to lose money. We want to survive through this thing. You guys see that? Now, in a perfect world, we would have credit tightening now so that the recession that we're going to go into isn't as hurtful to the people that are still purchasing recklessly. We need credit tightening now, not when we're in recession. But I did want to let you guys know that's what it looks like. Now, let me actually throw a max up on this. Now, we do have credit tightening ahead of a recession. I just wanted to show you that. So credit tightening has been happening, but it's been going down since Q3 of 2023. So that's not a good thing. All right, now let's keep going. Let's see. Okay, so here's Case-Shiller. Let me see. I'll probably just, okay, so here's Case-Shiller, you guys. I'm just using like the 20 city composite here, but I wanted to show you essentially, back in the GFC, home prices did start declining prior to recession, but they really started declining through recession. Do you guys see that? And I think that what's really important to understand here is the foreclosure crisis really didn't happen until 2010 and 2011. So this decline was for multiple reasons. It wasn't just because of some foreclosure crisis, and it wasn't just because 2,000, foreclosed homes hit the market. Like the real crazy stuff, again, did not happen until we were out of recession. We were already out of recession. But again, you guys, home prices went down when we went into recession. A little bit before that, you see, a few months before, but when we were in recession, that's when that really started happening. Now, likewise with foreclosures, take a look, you guys, because job loss corresponds with foreclosures. We didn't even have a foreclosure situation and a foreclosure inventory until we were already in recession. Okay, so it makes sense if we're not in recession, we don't have this spike in stuff, but I wanted to make you aware that it happens generally after, right? Does that make sense, you guys? Hope it makes sense to you. Okay, that's my little preaching. Hopefully you guys learned. I really hope you did. Now, I mean, again, you guys, put it in perspective, what type of economics do you guys think is better? I mean, the whole Keynesian thing, we could just keep printing, fiscal spending. I mean, you guys, assets are just so oversaturated right now. I mean, that's why they're giving the immigrants that are coming in here illegally money. They got to get the money into the economy. So they're like, here's your $5,000 immigrant, spend it, and then kick rocks. They only want them to spend the money. They don't care who's spending it. They need people to spend money so that our economy continues to do well. But what I'm saying is fine. You can keep digging the hole. You can keep making things, worse and worse and worse. But there gets to a point, and we're coming to it, where consumers are just fed up. They just get broke. And consumers are already getting broken. We see it in the data, you guys. Anyways, let's go into our first video. Okay, we're going to go into our first video. I'm going to do a quick timestamp for our first video. Now, the first video is basically on, there's only so long that this can keep on going. I mean, this is not sustainable. So this video is going to talk about how it can't keep on going. We can't keep on this path. Something's going to happen. The disagreement is like Jeff, me, everyone talk. The disagreement is what's going to happen next. And I want to say this last thing before I play this video, and I'll stop with my ranting, you guys. I look at COVID as an injection of Keynesian theology, but I do not think it's the new normal. But I definitely think that COVID, all that stuff that happened through COVID was that injection of that Keynesian theology that people want to make the new normal. but I'm not so sold on that. Anyways, guys, let's listen to this. If you guys can, let me know that the audio is good.
Let's talk markets right now. Joining us for that is Emily Rowland. She is co-chief investment strategist at John Hancock Investment Management. Emily, you say that the markets right now are kind of like a moody teenager. Why do you say that? You want to explain?
Sure. So we've been in this period where the economic data for April are actually coming in pretty disappointing. You had a slew of it last week. Consumer confidence at a 2-year low. Both the ISM manufacturing and services PMI is slipping into contraction. Of course, the April jobs report missed expectations by a mile, but risk assets are loving it because we're back in this bad news is good news feedback loop where you're seeing this excitement that maybe expectations that the Fed can cut are being revived. So we're seeing risk assets take off, Bitcoin surging, unprofitable growth at any price type companies are leading. Chinese equities are moving in parabolic fashion. It feels like a little bit of a phase, like a moody teenager would go through. They're kind of erratic. They can be unpredictable. They can be strange. But you know that they end at some point. So we're suggesting maybe you ride the phase out and continue to lean into higher quality companies that are trading at reasonable valuations.
I was going to say, what happens in the next phase? You think the markets come back down or?
Well, I think there's only so long that the economy can operate at these higher rates, right? So eventually something is likely to crack. We're likely to see the unemployment rate go up and experience an economic contraction. In that type of environment, we would suggest fading riskier assets, still owning equities, but again, those higher quality stocks that are going to have a better ability to navigate that late cycle environment that eventually unfolds into contraction.
Where do you see those stocks? What sectors are you talking?
Yeah, so we still like technology stocks. If you want quality, so great balance sheets, lots of cash, great return on equity, mega cap tech is going to be your poster child for that. Of course, we know we've got a little bit of a valuation issue with tech. Those stocks are overbought. They are doing the bulk of the heavy lifting from an earnings standpoint. But if you look at something like the S&P 500 growth index, it's trading at a 45% premium to its 20-year average. So we want to balance that with stocks that are actually on sale. So we're looking at things like mid-cap stocks, particularly industrials that are benefiting from all the fiscal spending that's going on. Stan Druckenmiller did a great job talking about this on your show yesterday. So we want to follow where that deficit spending is going. And it's things like infrastructure projects in the United States. We're seeing a booming environment in the Midwest stocks as being the best way to play that, given their overweight to the industrials.
Given they're overweight. So, it is hard to figure out what's going on in the economy right now. Wanted to read this real quick, guys, because, man, I hate talking about immigration so much, but I wanted to read this comment. Bro, appreciate you, bro. Appreciate you. The U.S. has been broke for a long time ago. And if we look at the deficit, they're not wrong. We have been since the year 2000. I think 2000 or 2002 was the last time we had positive GDP, without a deficit, I believe, a long time ago. And they're saying it's ignorant to think that immigrants are getting money like that. I mean, honestly, Family G, I think it's ignorant not to take it into consideration when we have the data now. I don't want to talk about it. Okay. I don't want to take sides in that fight. I have my own personal feelings and I don't want to share them. I know it creates division, but it's ignorant to think that it doesn't have some type of effect. Because there's the last reports I read, 11 million people. And it was something, I think, like $2 trillion. I don't know. It was something crazy, but I'm not blaming them. I know it's policies, right? It's administration policies, all these policies. I'm not blaming the actual people. But what I am saying, Family G, is we got to figure out what's going on. That's what I'm saying, right? We got to figure this out. Asset prices are squeezed. No one could afford anything. Why is this happening? Why didn't we have our reset? Why did we have deflation in 2022 and then it stopped? Okay. We just got to ask ourselves these questions. I'm not trying to be mean to these people. I just want you guys to know that. All right. But again, I think it's an important topic. So, but I do apologize if I offend anyone talking about immigration. Just know that I hate it so much talking about it. Now we're going to go into our mortgage report, you guys. But before I get into the actual report, let's go over the pricing, because remember, I want you guys to stop talking about interest rates and start saying that it's the pricing that changes every single day. And here's an example of how pricing works. This is a pricing sheet for a loan amount of $570,000. 95% LTV. This is a 30-day lock. Remember, the longer that you lock your rate, the more expensive it becomes. And remember, there's a par rate, a discount rate, and a rebate. Okay, so your par rate today, if you look here, is 6.25% because, and I made this a little bit simpler, because there is no charge. Okay, you see there's a zero right there. Now tomorrow, that may be different. Tomorrow it may be a cost. Okay, but today 6.625 is a par rate, which means there's no additional cost. Now, if I wanted to get a 6% interest rate, the cost would be $15,000. So I don't want to pay $15,000. Okay, now the way you determine typically if it's a good deal is you look at the difference in payment. Okay, so the difference in payment from there to there is about $230. So the difference in payment between 6% and 6.25, we'll say, is $230 a month. Okay, so decent. But the problem is, you guys, that costs $14K to accomplish. So normally normally what I do is I go 5 years. If you can get the money back in 5 years, it's a good deal. But we're in an environment right now where, the loans are so crazy, interest rates are so crazy, everyone expects rates to go down, that I'm not buying rates down. I'll wait for rates to drop. Hypothetically, I want to be very careful how I say this, but I'll wait for rates to drop, and then I'll just refinance versus paying $15,000 to get my rate lower, as an example. But we're going to look at the 10-year right now. Let me switch this up like this real quick. Okay, so here's the 10-year, guys. We are elevated. It's very interesting. It's actually started going up as of about 6:51 Eastern time, but we're sitting at almost 4.5 again. This has been a wild ride. It has plummeted. And then now it's kind of shifting back up again. So again, sitting at 4.5%. Let me show you guys what this is doing to residential mortgage rates. We're still in the 7%. We're still tight out there. That's very, very good. We need sustained inventory. Inventory is coming back. Make no mistake. Unfortunately, you guys, there are still some housing markets that inventory has not come back, that will remain tight. I believe in those markets, like those super tight markets that don't have the inventory, like there's more demand than inventory, and that demand is just absorbing it. For those types of markets, I think you need that systemic bust. You need that labor market to soften, because those markets aren't like, for example, Austin. Austin has so many factors on why it's going down. Migration out. That's a huge one. People are leaving Austin. The job market is softening, and there's new construction. Those, to me, the three biggest things in the housing market from a price standpoint: number one, the job market; number two, migration; number three, new home construction. That's what we're seeing in individual markets. So divided because we don't have that bust. We don't have that nationwide sentiment that, oh my God, house prices really go down. And then we don't have investors liquidating. But regardless, you guys, here's the interest rates. Right now, we're sitting at 7.15%. That's a conventional. FHA is sitting at 6.61%. 15 under, and then that's under 15-year. 15-year sitting at 6.63, so 2 basis points lower, and then also 1 basis point lower than VA. VA sitting at 6.62%. Now, remember, you guys, typically FHA is usually cheaper if you have minimum down payment. The biggest disadvantage of FHA mortgages is the mortgage insurance. You have to pay an upfront mortgage insurance premium plus a monthly premium as well. So remember to shop. Figure out what's best for you guys. Remember also that a broker is normally better than a direct lender. Now, let's see what the market feels like is going to happen as far as what the Federal Reserve is going to do next with interest rates. Here's CME Fed Watch. Now, the market's saying this keeps changing. I'm going to December. They're basically saying 10% likelihood, no rate cut. They're pricing in 31% likelihood of 1 rate cut and a 36% likelihood of 2 rate cuts for the year. And when I say 2 rate cuts, what I mean is 50 basis points total. So they're saying 25 basis point rate cuts at a time. But if we have an economic recession, it's probably going to be 50 basis points, 75 basis points per time. That's probably what will happen. It probably will not be, I don't know for sure, but it will probably not be quarter basis point cuts, guys. I mean, do y'all really think that? Now take a look at this, guys. This is what I want you guys to be so studly. Well, I don't know how to say it the feminine way, but I just want you guys to be really, really sharp consumers. I really want you to attack an amortization schedule because it's super evil. I'll cover this quickly. This is how mortgages are calculated. I'm doing a calculation on a $324,000 loan at a 7.15% interest rate. The entire time paying that loan, you will pay back $463,000 in mortgage interest, which is usually paid a predominant amount in the first 10 years of the loan. I want you guys to pay attention to this amortization schedule here. You see that the first year of your mortgage, year one, you pay $23,000 in just interest. Doesn't rent sound a little bit better? So, but it is tax deductible. Talk to your CPA. So first year you pay back $23,000, whereas the 29th year, just to put this in perspective, you only pay $2,700 in interest. So it's front loaded with interest. And if you guys want to conquer it, put money down towards your principal. If you guys put down roughly $18,600, if you paid your loan down to $305,470, you guys save over $110,000 in interest. Now, also you can make extra payments. So what extra payment should I put here, guys? Give me one in the comment section below. I'm going to show you guys if you pay extra money towards your principal, it saves a lot of time and a lot of money. Give me an amount below. Should $200, $1,000, $10? How much should I show for extra monthly payment? What do you guys think? Nikki said $500. All right, so let's put $500 in here. All right. Oh, we got double 500. We got a 5, a 1, and a 5. Okay, I like you. I like that. So say we're gonna meet with our spouse. We're rebudgeting. We're gonna get ahead in life. We're gonna put $500 every single month into that principal, into the actual loan. Let's calculate. Let's see how much time we save. Okay, so oh my gosh, so we turn a 30-year loan into a 17-year loan in 10 months. So we instead of refinancing it to a 15-year loan, we basically turned it into a 15-year loan where we saved $214,000 in interest. And again, we save roughly 12 years and 2 months. Isn't that astonishing how that works? I mean, you guys, please, please, please. I mean, pay attention to the amortization schedule. You guys can really get ahead. You guys can really become rich when you retire. You just have to do a little bit of discipline up front, all right? And don't fall for the rat race. Don't be buying subscriptions. Don't be going out to, I mean, you do whatever you want. It's your life, but I'm saying like right now is like a really good time to stack cash. Right now is a really good time to figure this out and to strengthen ourselves, understand people are running out of money. The delinquency rates are skyrocketing, but we're going to go into our next video, which is basically the consumer is getting crushed by inflation. Okay, that's a big piece of the puzzle. The consumer, us that are paying for this, right? If we're still paying for this, then it's still the economy is still going to float. All right, so let me play this for you guys real quick.
Coming from.
All right, now this guy is very, very interesting. Again, he's going to go into basically what he's doing as a company to combat overpriced food. So it's in relation to food. It's a pretty good video if you guys pay attention to this. It's pretty cool. All right.
This is coming in with a bird's eye view on spending and the changes they're making to attract value-minded shoppers. Joining us is Joel Rampold. He is the U.S. CEO of Lidl. Joel, welcome.
Hi.
Please, explain to us what you think is going on here with so much mixed commentary about the consumer. What's Lidl's experience?
Yes, well, every category of U.S. retail is seeing inflationary pressure. Grocery is no exception to that. Lidl is no exception to that. We see some of it coming from energy prices, some of it coming from transportation prices, well-known facts around fuel and driver shortages. All of that combined is putting upward pressure on prices. What we're focused on is controlling what we can control. We're focused on being operationally excellent, finding costs, driving it out wherever we can, finding wastage, driving it out wherever we can, so we can counter that by putting downward pressure on prices by operating as efficiently as we can.
What's the mix of price and traffic in your numbers these days?
So what we are seeing is growth in customers. Our customer counts are actually very, very healthy. Where the pressure comes is in basket size, and we are always focused on keeping our prices as low as we possibly can. Everywhere we can take cost out, we try to turn that into putting pressure back on prices. Particularly as a private brand-led company, we're very well positioned for that. Customers are really looking at the private brand versus national brand equation much harder than they have in recent years. And so that's very favorable for us. We're able to offer the same quality, or in many cases, better quality at a much better price. For a Lidl shopper, that can be about 40% savings. And that's very favorable for us in terms of the price equation. Customer traffic equation continues to be very strong.
Sure. So in other words, people's average transaction price, for lack of a better word, is it down? Is it flat? Is it just up slightly?
It's under pressure, right? And we're having to do a lot of work to keep that number where it needs to be. And it's logical, because when you look at industry data, we've seen recently that the American family in a month has gone from visiting about 17 supermarkets a month a few years ago to almost 21 grocery stores a month now. So they're not doing that because they enjoy gassing up their car. They're doing that because they think they may be able to get a better deal by going to multiple different outlets. And the way we respond to that is we want to make it very easy for our customers. We're not heavily promotional. We're everyday low price. Every single day, they should be able to get our very best price on the items that they're looking for, the items that they're counting on us for.
We heard from Planet Fitness. They said they think there was a shift in consumer focus in the new year to savings. Dine Brand says the lower income consumer is more aggressively managing their check. That sounds like what you're talking about. Energizer said higher income consumers are spending more freely than middle to lower income consumers are. Would you say that that's the same phenomenon you're experiencing? Are you benefiting from any trade down?
So we're benefiting from that in a number of ways. The U.S., according to federal data, the U.S. families are spending more of their disposable income on food than at any time since the 80s. So obviously, in that situation, they're going to be much more focused on what they buy and how much they spend. We benefit from customers looking at us and saying, particularly on the things that are most important, the things that disproportionately drive their decision about where to shop, which is fresh product. We offer exceptional value. When you walk into a Lidl, that's what you see. Fresh fruit, fresh produce, fresh bakery, just beyond that, fresh protein. Those are areas where we really excel. And those are areas where customers are taking a really, really hard look.
Right. And I would say that perhaps the I don't know if I'd call it deflation, but the price hikes have slowed, and that part of the grocery store and some of the other supermarkets as well. I don't know if that's keeping people from maybe seeking out the value in Lidl, or if they still are.
No, we see very strong customer traffic. Customers are still under pressure in a lot of categories, and again, the private brand equation for them is exceptionally strong. The things that we do every day to drive costs down, and we're relentless about putting downward pressure on prices. Inflation pushes up against us, we push down. Sometimes we have to yield, we have to go up, but over time, in inflationary times and in less inflationary times, Lidl will have the best prices. And our promise is you get the best quality, you get the best price, you don't have to compromise. We do that by being relentless about operational efficiency and by being a private brand company.
Do you guys believe it? Do you guys believe him? My worry is when they do that, they're going to sacrifice quality. And that's what I really worry about. So I want to get into our recession and liquidity update real quick. I got a lot of juicy stuff to show you guys, but I wanted to pull up this comment. Jack, I really appreciate your support, brother. That means a lot to me. This is what Jack is saying, a longtime viewer of the channel. I think a black swan is coming soon. Emergency rate cuts in June or July. Here's a laugh for y'all. My father-in-law owns a home building company in Vegas. He thinks prices will go up in the next 6 months. He said that for 2 years. Now, Jack, so talking about black swans, okay, as that video was playing, I was thinking about what you were saying. What if, because it's like we know what is coming, right? Like CRE, commercial real estate, like we get all that, like geopolitical, China's markets, stagflation. What if the black swan, Jack, think about this. What if the black swan, okay, is consumer awareness? What if consumer awareness is the black swan? What if it's really the sediment, people waking up to what's going on and like, oh my God, the economy can collapse. Oh, we learned that 10 years ago, or we didn't learn that 10 years ago. What if it's just consumer awareness, man? What if that's what we had back in 2022, right before the bank term funding program, when sediment shifted? Because if they would have let the banks collapse, like they should have, Austrian economics, right? They should have let them collapse, the weak. And plus, there was only the rich people anyways. Imagine where we would be. The sentiment, the awareness, right? Like, oh my God, banks can collapse and the Fed's not going to save them, right? What if the black swan is really just people waking up? What if that's what it is? Now, as far as new homes, here's the thing with new homes, man. I just did a video yesterday in Houston. I went through the entire west side of Houston, and I went to 3 of the top subdivisions that had the biggest price cuts. I got price cuts to show you guys from $95,000 to $186,000. Depending on the market, new home builders are in trouble. Depending on the market, there are some markets there are some markets where those new homes are being absorbed right away from the demand, right? Like East Coast, especially northern states, it's being absorbed. But in other markets, like what I've been covering across the nation, the demand cannot absorb it. There's just too much supply. And that's why I'm saying $186,000. But also we know that because of the supply. The supply of new homes right now is over 8 months and it's underreported. Do you guys want to know something interesting? Does anyone know how much supply we had, say, in 2017 for existing homes? I want to ask you guys that question. Okay, so here's a question. So we're going to go a couple of years before the pandemic. In 2017, for existing homes, how much supply did we have? 2017, before COVID. In 2017, how many months of supply did we have, Jeff? How many months of supply did we have in 2017? Any guesses? So we got 8 months. First one's 8 months, 3 million. No, 3 million. We got 3 million. We got a 4 months, 7 months. Yeah, months. 6 months, right? Like that. Yeah. So mostly it's like, yeah, balanced market, right? 3.9 months. We had 3.9 months. You guys want to see? I wasn't going to show you this. I wanted to save this for a video that I'm doing where I'm slamming Redfin for lying, but I want to show you guys this real quick. Let me just show you this just real quick, okay? Look at this. Like the whole inventory thing is just so BS. Again, I didn't want to show you this, but in 2019, this is existing. We had 3.9 months of inventory. In 2017, we had 3.9 months. So what are these people talking about 6 months? We need 6 months. We need 4 to 5. The last time we had over 4 months, okay, was 2014. We had 5.2 months all the way back to 2014. They are lying to us about like this whole lack of inventory. Now, as far as actual inventory, so 2017, Jeff, 1.4 million. That's it. 1.4. We've never, the last time we had over 1 million into 2 million was in 2011. So all these people that are like, we're short 4 million, we're short 5 million. When in history have we had that many houses? Never. If we go back to 1999, they had 1.7. I mean, look at this, guys. The most that they had for listings was like during the GFC was right before the GFC in 2007. We had 3.5 million listings. When we entered the GFC, listings went down, not up. It reversed. It did not go up. It went down. So when I went back to like, look at all this, I'm like, these liars, these such liars. Why do we need 4 to 5? Why do we need 6 months? Why do we need 6 months? Last time, this is crazy, right? 3.9 months in 2017. Now in 2018, we had 4 months. Right now, you guys know how much we have? We have 3.2. We have 3.2. Okay, so isn't normal 3.9? But again, I mean, things were different back then. Anyways, I just wanted to show you. I was going to save that for my Redfin. I got a lot of stuff to show you guys on Redfin. I'm going to show you the Redfin. But what we're going to start, guys, let me go into liquidity. I apologize. 42.30. So just my timestamp. We're going to go into liquidity right now. All right. So take a look here. We're going to start with some economic warnings. Let people forget about these really important warnings right here. The first one is the yield curve inversion. This is the 10-year and the 2-year. This has been crazy. We have been inverted for a little over 2 years. We recently got inverted, I think around April, but I have this long chart so you guys can remember. First of all, longest we've been inverted. And when we go, so the inversion is not creating the recession. First of all, the inversion is warning us of a recession that's coming, and it always warns us. And when anyways, we could go back and forth all day. But what I'm trying to show you is this inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession. So we've been inverted for 2 years. That is a huge recession. It is like the biggest of all indicators of recession minus actual negative GDP. This is huge, okay? But in addition to this indicator, we also have this indicator of recession, which is the annual change in government jobs to non-farm payroll gains. And if you look here, going into the great financial crisis of the GFC, that spiked to 25.15%, okay? Right now, okay, as of the date of this report, through November of 2023, we're at the same spot. We're at 25%. So again, Keynesian economic theology is what you see here. This is all Keynesian economic theology. The Austrian economists are like, if they do this, the problem will get worse. And this is what we see here. Okay, you see that skyrocketing government involvement in the labor market? Here's another one. It's not just that. Here's the change in non-farm payrolls, the government versus the total. Again, look at this. This is, and go back to 2022, the beginning of 2022. Okay, it was only a change of 5, 1, 2%, kind of spiked to 11%, went down to 6, -3. Oh, this was -2. And now 24%, 43%, 25%. Keynesian economic theology. And that's what it looks like. Again, people say it's just making the problem worse. But these are things that feel recessions. These are indicators of recession. If the economy is healthy, we don't need government intervention. What they are trying to do is mitigate the losses. They are trying to keep it propped up, probably as a result of the election. I mean, come on, guys, right? I mean, look at this as well. Okay. Here's the other thing. This is what I'm saying. All right. Now we'll stop talking about immigration. And to that family, G, I really appreciate you commenting, man. I totally understand. I'm going to stop talking about it. Okay. So here's the thing, though. The assets are squeezed. The assets are squeezed, you guys. This is median prices for houses for sale. This is under new residential. This is where Comic Lever got all butthurt because it says median prices of houses sold, doesn't specify new versus old, but this is quarterly. Up here, it says that right here. Either way, I don't care about that guy. I just wanted to explain that real quick. Now, here's the thing. This is what I'm saying. Assets are oversaturated. The freaking stock, everything is oversaturated. They got nowhere to spend the money. No one can spend money on housing anymore. Look at the run up. This is what I'm saying, Jeff. This is what I'm saying, dude. It's oversaturated. Now, this is a run up. This is a different type of run up. It's very similar when looking at existing, but this run up is just not sustainable. Asset prices, they're just saturated. They're just saturated. We can't even afford it. Even if the rates are down, we can't even afford it because the price says, you guys, assets are oversaturated. You know this, okay? And in addition, what I'm saying is if it would be fine if median income kept up with it, adjusted for inflation, right? Fine. Let's have this asset prices increase, but in order for it to be sustainable, it generally must match the fundamentals of income growth. Price growth for homes needs to relatively match income growth. And so when we have this massive spike in asset prices, like you see here, at the same time that real income is going down, that's what I'm saying. It is not sustainable. Now, when will it collapse? I don't know. And I don't even care at this point because I know it's going to, because history and human nature tells us so. And keep going. Let's keep going. Okay. This is the other thing I'm saying. And we see it in the delinquency trends. And this is outdated info. We don't even have Q1 of 2024 yet. We don't even, and on the reports that we're reading, it's like record high delinquency rate. We don't even have it yet. But again, asset prices are squeezed. People are running out of money. People are not paying their bills. The delinquency rate trajectory, we have not seen trajectory like that since the GFC. This is showing people are hurting. People can't pay their bills. People have poor spending habits. Inflation is hurting us. The trajectory, yes. Is it still relatively low compared to the GFC? Yes. Is it still relatively low compared to the last decade? No. We are above the last decade averages. Okay? So again, more signs that the consumer, which we need to spend to keep the economy afloat, is in danger, is getting battered. We see that, guys. Now, let me show you what else we've seen. Here's the problem. Here's the stagflation. This is a stagflation. This is why we have so much issues. This is what we need to go away. This is because of the Keynesian the Keynesian philosophy. This is it. All of this government intervention, this fiscal spending, it's all fiscal. Let's spend, inflation reduction, this war, that war, let's spend, let's hide some crap in legislation, let's even spend even more. They are on a fiscal spending spree like we've never experienced before. I thought this was the US. Look at the reverse repo market plateau. This is we have been plateaued in the reverse repo market since February. This is like the private sector in a sense. This is like all of our money. This is like excess money. This is the money we need to go bye-bye. This is the money that I was saying, like by the end of this month, this should go bye-bye. But instead of that happening, as of around February, it just went sideways, which to me is showing us, I don't know if it's the rich money or whatever, but the monetary policies and the restrictions like Basel III and other restrictions is not enough to counter the fiscal spending. There's too much fiscal spending going on still. We know that because consumers are being battered. So where is the money coming from if consumers are getting battered? It's coming from the government. Okay? It's coming from them. And we have stagflation right now. The reverse repo market is stuck. It's crazy. Now look at this as well. M2, and this is my other thing that I'm trying to tell you guys, like, this is why we're in stagflation. This is fiscal. This is the fiscal freaking spending right here. And that Keynesian, that Keynesian philosophy that was injected. And it was injected during the GFC and re-injected during COVID. That's why you see M2 going up, even though, again, quantitative tightening, consumers are getting ransacked. So how the heck is M2 going up again? How the heck is M2 going up again? It is. It's going up because, again, fiscal spending of our government. This is stagflation, you guys. We got more money to burn. I hate to say it, but this is the propping up. We got more money to burn, guys. It's an unfortunate thing, but it nevertheless, it's here. But look at this. Okay, here's the total assets held by the Federal Reserve. You guys don't think that they control the mortgage market? Come on. Yeah, they can only get you overnight rate, right? But look at that. Look at their holdings. They run the world. I'm just saying. Okay, they run the world. Now, look at what happened here. Okay, remember back in 2023, around March, we had the Bank Term Funding Program, and that stopped deflation and price decline in its tracks. That shows right here on that graph. Travis, you're wrong. No, you're wrong. You know what I asked myself, guys? I asked myself why, right? Like, okay, this is what I think is going to happen. Oh, it didn't happen. Why? Why didn't it happen? You know, a lot of the bulls don't take that right here. You guys see this Keynesian injection right here. This is an injection of liquidity. This is in a sense, this is kind of like quantitative easing. You see it here. Now, they have been going down, but this really put us back significantly in our fight against inflation. And I believe what you see here is why, a primary reason why we do have that stagflation. Because not only do we have the deficit spending, the Fed made that window on top of the fiscal spending. It was a double whammy. Anyways, just saying, guys, I mean, I felt like it was a double whammy right there. I'm going to show you guys some foreclosure sites as we end this. I'm going to show you guys one more video, and then we're going to go into those foreclosure platforms that I got from Ashley Pickens yesterday. Hopefully you guys like that. Really cool foreclosure sites. Now, let's see here. The last video we are going to listen to, you guys, is, the Fed is going to cut. You guys are about to listen to someone that is saying the Fed is going to cut interest rates this year because we're going into a soft landing. Let me know your thoughts on how you feel she does explaining this. Now, I think that she's foolish. I think she's saying that we're going to go into a soft landing and that they're going to cut rates because we hit our 2% inflation target. But we're going the opposite direction. We're not going towards 2%. We're going higher. Okay. There's nothing wrong with the economy. It's super healthy. Yeah, right. Anyways, enjoy the
great point a half an hour ago about soft landings and that they are not smooth all the time, even though they may be soft, right? Talk about that a bit.
That's exactly right. And I think the market should listen to John. There's been so much back and forth. Is it a hard landing? Is it a soft landing? And I think what we very much feel will be a soft landing. But I think what's been missed by the market is that a soft landing, if you think about it literally at the airport, right? You're landing on the tarmac. There are times when you have to brace with the tray table in front of you. That could be what we're going through in the economy. I think the 3 hot inflation prints we had in CPI were a bracing of the table in front of you. But it's how it broadly trends and what the bigger theme is. This is a soft landing. We've got good growth. We've got a normalizing labor market. We've got inflation channeling in the right direction. Yes, some bumps, but we're going in the right spot. This is a soft landing. And I think we heard from Powell, he is seeing a soft landing for sure.
Right. The house view at Goldman has been pretty constructive for a while now. I think Jan has 15% recession odds, looking for a July cut, looking for relief in things like insurance and shelter. So where does that lead you to on the duration conversation right now?
Right. Well, we think it's really a good time to extend duration. So there's a lot of money sitting in cash right now. There's about $6 trillion in money markets and the very, very front end of the curve. We think that cuts are happening. They're going to start either this summer, they're going to start July, or they're going to potentially come in September, but they are coming. And as a result, it is the time to extend your duration and lock in those yields. The really exciting 5 handle on money markets, that's going away soon. The average duration of a money market fund is 2 weeks. So if you think about as that starts to work through the system, you're not going to get those great yields in the front end of the curve. Move out the curve into great spots in fixed income where you can take advantage of the high yields you're used to and want.
Right. But the choppiness you're talking about does still lead you to high quality, right?
That's right. This isn't a market in which everything's going to do well, because what is different here and the playbook changed is we have a higher cost of capital. So there are absolutely countries, companies, structures, consumers that can't handle this higher cost. And so you have to be really discerning in where you invest. Big picture, broad strokes, up in quality, leaning into high quality assets, investment grade, or up in quality and high yield, double Bs, single Bs. That is a great place to be. And the other thing we think is really important is that this is a market, again, with that higher cost of capital, that you want an active manager, because someone needs to be looking at the portfolio and saying, I want to stay away from those triple Cs, or I'm worried about that commercial property. Let's pick the right things that are going to do well in this environment.
Right. You talk about geographic diversity, and I wonder why. What about the current environment leads you to making sure you're not concentrated in one area of the world?
Sure. Well, it's really interesting right now because there's global divergence, right? You have the Bank of Japan that's likely to hike. You have the Fed, July, September, let's see, going to cut. Sweden cut, actually.
Yes.
So you've got all of these things moving in different directions. That leads to very different outcomes. This is a beautiful place to be in fixed income and pick and choose, because you can do interesting pairs. Like you can be long duration in the US, you can be short duration in Japan. We can put all of this together to have a much better outcome and alpha opportunity for our clients.
When I don't need to belabor like every data point, but when an Atlanta Fed comes in this week and says Q2 tracking at 4.2, how do you look away and not get seduced by numbers that might lead you to change your whole thesis?
Yeah, I think you have to pull the camera back and you need to think long-term. We are long-term investors. We're also investors, I think, with humility. I think that's really important, and I think that's a message that we'll have at the investor forum today. Investors really do need to be humble. We have seen just in the very first quarter where Atlanta Fed would have told you a very different kind of print. So we have a very recent data point that suggests to you need to pull the camera back and think broader. The bigger picture is, as we forecast out where GDP is going to go, it's strong.
Finally, you mentioned the forum, and I wonder, when you talk about, say, duration extension, do clients push back, or are they willing to be led on that front right now?
Clients are asking the question, they're looking for advice. What are we supposed to do? The pushback that we've received is, hey, being in cash has really worked. And you know what? We are saying, congratulations, you're right. Cash was a great place to be. We are not denying that. And we are not saying that the investors that we speak to aren't smart and haven't made prudent decisions. But together, we want to work together on the forward. What should you do next? Let us help you think about solutions for your clients. That for us is extending duration. Fixed income right now has yield in a way it didn't have before. This is a great opportunity. And again, if you really...
All right, I see you guys in the comment section. Okay, we're done. We're done with this lady. You guys are funny. All right, so I'm going to show you guys the foreclosure stuff, but Nikki really brought up a great question. Is globalization is this good or part of the problem? As American consumers, is part of the problem because, Nikki, in my opinion, the world, because the dollar is the world currency. When we print money, it creates inflation, and also it creates inflation in other countries. A lot of other countries buy the dollar or use the dollar to buy their currency. I mean, there's this whole game with currency. And as a consumer, it is a problem because it's like a buffer, right? It allows us to overheat our economy more and to put more pressure on the American consumer. And the globe, other countries are absorbing that, just similar to the reverse repo market. So it's a suspension system. I mean, globalization is a suspension system. And I believe also, Nikki, that's part of the reason why we haven't gone into recession is the world, right? The world's just in the bad shape as we are in. So I think it's an issue for right now. The thing is, Nikki, I also think, like, in a perfect world, like if we had leaders that weren't corrupt, greedy, and put, their people before themselves and before their constituents' financial bias, I think it might work, but the problem is we have men and women that are human beings, and they can't control their emotions, and they can't control, their heart, their lust for things. And it's just very sad. It's very sad. So good question. I'm going to show you guys the foreclosure stuff, but I wanted to throw this on the screen real quick for y'all because I wanted to show you. So this is Audubon. This is a Houston location, guys. This is one of the subdivisions I went to yesterday. You're looking at the home, well, actually the new community that has the biggest price cut in all of Houston at $186,000. So just wanted to mention that. I have that video. I'm not sure if I'll be able to edit that for today. So let me show you guys the foreclosure stuff. A lot of people loves these little forms here. Now, Ashley Pickens gave us this yesterday, so I wanted to like check it out a little bit. This is called Prop Wire. This is a foreclosure and auction system, and this is very, very interesting, guys. And this is crazy. So I selected Texas, and I put all I want is REOs. So like properties that were taken back from the bank and the auction failed. Okay, and then I put Texas. Look at how many came up. 50. Oh, my picture's in the way. Sorry. 15,872 bank-owned properties. What? Did y'all know that? Did y'all hear what I just said? Y'all want to go to PropWire yet? Can y'all go to PropWire and make sure I'm looking at this right? Now I've selected like, multifamily, land, SFR condos, but they say in freaking Texas, almost 16,000 REOs. Oh my God. Oh my God. If you guys want to know like how to get involved in that, just watch my video from yesterday. But this is one of her favorite websites right here called PropWire. Now, if you guys want to look at commercial foreclosures and auctions, okay, I went to the one that she suggested as well called 10X. This got some crazy stuff in it. So I just selected so you can select this is commercial, right? I just selected multifamily. Okay, that's it. And I have 24 multifamily homes that are under auction, guys. Look, if you guys want to own some multifamily, oh my God, look at this one. This one's crazy. This one this is like an apartment complex with 40 freaking units, and the starting bid is 350. Jeff M, let's buy this, dude. Let's buy this. There's 400 apartments, starting bid $350,000. Y'all interested yet? Y'all come back here, check this out. Just trying to give you guys some tips, trying to give you guys some tricks, trying to get you guys ahead of the investors. That's crazy. Okay, that's called 10x.com. Okay, I hear you, Vegas. I ain't gonna throw the comment up, but I hear you, Vegas. I hear you. You got to do your due diligence. Now, if you guys want to do land auctions, holy smokes, this is the website, landandfarm.com. And I put Texas and I put auctions and in Houston, and you guys, I have like 6 properties that are up for auction. Look at that. So like, if I want to go out and like bid on this property, I can do that. That's so crazy. And then they're like, look at this. Let me scroll down here. This one's right. These 2 right here are down the street from me. This is in spring, both of these. I'm just saying, you guys, we got some tools. We got some resources. Hopefully we all grow together. I want to grow together. I want to win. I want you to win. I want everyone to win. But I am a renter. I am renting right now. I am on the sideline. I am choosing to be on the sideline, but I am looking every single day to find a great deal. I want a great deal. I still believe the longer that we rate, the better off we will be as far as a deal. So long, and listen to what I'm saying, as we prepare right now. Each and every one of us needs to, if we're not where we want to be, each and every one of us, guys, I'm telling you, please, we need to pause real quick. We need to just rebudget. We need to start with rebudgeting. Just take a look at the subscriptions. Take a look at going out to eat. Those things alone will get you ahead. Please, guys, if you're viewing this, if you're listening to me, start there. Please, that's all you need to do. We start there. We control our lives. We control our spending habits. And then we use the money that we save to invest, okay? Whether it's T-bills, whatever it is, it starts with us. The economy is a mess. We know that. But you guys, please, we are incredibly powerful people. Each and every one of us is so incredibly powerful if we just choose to be. And it's time to start deciding to be great people. We need to start deciding to make the effort to get out of the rat race. And I'm with you guys. I'm just a normal person. I'm not some millionaire. I'm just a normal guy. I'm with you. And I've been behind the scenes, and I will help you. I'm going to teach you guys about loans, about real estate, about properties, about what to look out for. I'm with you guys, but I need you guys to meet me halfway. I need you to meet me halfway right now. And I need you guys to start studying right now. Take the home buyers course, start using the forums, start training other people, start loving your life, and be excited that you can make a difference, because we need you. I'm just one person. I need you guys. Okay. I'll shut up now. I'm probably going to do a morning live. I may do go try to catch a hammerhead, like a 14-foot hammerhead, like a historical record, and get a documentary of that. So I may do an early live on Monday. I just want to end you guys again saying, a lot of this is just in our heads. Okay. A lot of us just need to decide to do something and just do it. Please do that. You don't have to learn how I learned. I had to learn by losing everything. I don't want that to happen to you. I'll shut up now. Anyways, guys, I love you. Thank you for joining me. Thank you for being a part of the community. Please join Discord as well. This is a great community. You don't have to be alone in this. You don't have to be alone. Okay. Your decision making ultimately is yours, but you don't have to be alone. We are here from you, not just me, people in the community. We understand the frustration, how confusing things are, how there's such a difference of an opinion, but you guys got a great doomer because I'm better than most realtors. And not only am I better than most realtors, I'm better than almost all loan officers. So even though I'm a doomer, blah, 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 I will still cut those guys down because I know more than them. And so that's what I'm saying. I'm with you, but meet me halfway, guys. And other than that, if you're out there, oh my God, I'll see you.